Hello, my name is Dominic. I'm working in a group with Elijah and Kevin, and we will be discussing the Bank of Greece. We will be discussing the history of Greece's central bank, the central bank structure, the uniqueness of the central bank, policies adopted during the financial crisis of 2008, and the evolutions of the policy adopted.
My name is Elijah, and I'm going to be covering the history of Greece's central bank. In 1927, the Bank of Greece was established as the Central Bank of Greece with a £9 million loan under the Geneva Protocol. And the central bank was originated by the League of Nations in an effort to help the government with severe economic and fiscal issues happening in Greece at that time. As well, during this period, during World War II specifically, the Greeks moved their gold reserves to Africa to hide from the Germans in an effort to preserve their financial system. And after World War II, the Greeks dealt with new methods and internal controls to be researched and taken into consideration due to, at that time, Greece was in chaos and needed to stabilize their system. From 1950 to 1990, the Greek Central Bank dealt with direct in-control committees that were created and abolished conflicts with state ownership. And then throughout the 80s, massive deregulation occurred due to removing the committees created after World War II. And this was mainly dealt with the issues and conflicts between the people at the central bank who were in control versus the people in government. In 1992, the Greek central bank's objective was mainly to focus on getting its fiscal house to comply with the Maastricht Treaty. This treaty limited members of countries in the EU to deficits of 3% and public debt to around 60% of GDP. And so throughout the 90s up until early 2000, this was really the main objective for Greece and the Bank of Greece. In 1997, the Bank of Greece received independence, and the specified amount of control the government would have on the bank itself and monetary policy, and it's roughly less than 35% of ownership the government has, and that is put in place as a specified amount. And finally, in 2001, the Bank of Greece joined the European Central Bank and adopted the euro as its currency.
My name is Dominic Barnett, and I will be talking about the central bank structure. The structure and operation of the Bank of Greece reflects its special role and mission as a separate institution and as a member of the European system of central banks. Going back to what Elijah was saying, the Bank of Greece joined the European system of central banks and they adopted the euro as their currency in 2001, making them part of, like I was saying, the European system of central banks. So the bank is also responsible for controlling the minimum reserve account of domestic banks. Just like the Fed, they have control of telling banks what is the minimum reserve that they can have. So they follow all the rules and compliances that the central bank sets and gives them that power over the regular domestic banks. The institutional framework of the Bank of Greece combines fundamentals and independence from government action. So the Central Bank of Greece is not connected to the government. So the people who are elected to the central bank are not elected through government officials, making them a separate entity, making it a little bit more safer for people to invest in. Let's continue on with the bank structure. As you can see by the diagram, we know who the top dogs are and who the bottom dogs are. Starting with the shareholders at the top. The shareholders are the bank's supreme decision-making body that represents all shareholders and binds them by their decisions. They meet once a year right around April and they make rules and regulations that all banks will have to follow throughout the year. Next, we move on to the general counsel, which is entrusted with the general management of the affairs of the bank, which is the day-to-day of the bank. Then we have the audit committee who supports the general counsel of the bank. They also oversee the internal control system. They also oversee a bunch of different other agencies that would be at the bottom of the diagram. So then we have the administration, which is made up of the governors and the deputy governors. They are elected by the shareholders at the shareholder meetings and they serve a 6-year term. Then we have the executive committee, which controls the prudential supervision, which is the protection of depositors by ensuring that the financial institution adopts prudent risk management practices designed to ensure their continuing solvency and liquidity. Then we have the Monetary Policy Council. They analyze economic and monetary developments. Also, they examine the implications of the monetary policy formulated within the framework of the Euro system. At the bottom, like I was saying earlier, we have the branches, outlets, and agencies. So there's a bunch of them. They are listed on the Bank of Greece website as well. All those agencies are controlled by either the governor, deputy governor, or the executive committee or the audit committee. Just depending on what they are will depend on where they fall under. So like I was saying in the last slide, the bank is responsible for controlling the minimum reserve amount of domestic banks as part of the structure and control of what the bank does, giving the central bank the name of a banker's bank. The soundness and efficiency to oversee all payments and settlements systems ensure that the Bank of Greece must always be paying close attention to the member banks. Lastly, the central bank monitors the international development and institutional framework and fund transfers while complying and analyzing in risk and certain payment systems and operational risk of certain infrastructure.
This is Kevin Lady, and I'll be discussing the similarities and differences of monetary policy between the Bank of Greece and the Federal Reserve. First, I'll start with the Bank of Greece. It is their responsibility to implement the monetary policy that is formulated by the ECB's Governing Council. The primary goal of monetary policy within the euro area is to ensure price stability, also preserving purchasing power, sustaining economic welfare, creating jobs, and aiming at an annual inflation rate below 2%. All of these developments are measured by the Harmonized Index of Consumer Prices and ensure that an average change in prices for consumer goods and services remains stable for a certain period of time. The monetary policy decisions of the ECB are centered around two separate economic and monetary analyses. First, the economic analysis monitors current and economic and financial price developments and their impact on inflation within Greece. Changes in overall output, aggregate demand, and the developments in the exchange rate of the euro also play a role into a macroeconomic projection. The monetary analysis monitors overall liquidity conditions based on M3 growth and trends of credit for businesses and households. Next, for the Federal Reserve, monetary policy is achieved by utilizing tools of open market operations, discount rates, and reserve requirements. During the recovery period following the 2008 recession, we saw the Fed purchase government bonds to increase public sector spending and private sector borrowing due to low interest rates. This direct purchase of U.S. bonds can expand the money supply, drive down interest rates, and help stimulate the economy. The Fed took successful action toward a market recovery, but at the same time drove unemployment higher than ever before. The Fed exercised its dual mandate and injected even more money into the U.S. economy to achieve lower levels of unemployment and lower interest rates. In contrast to the Fed, we see that the Central Bank of Greece forfeited their ability to print their own money and lower interest rates when they joined the ECB. The ECB contains all control of membering countries. They can control printing euros and the Eurozone's money supply. They also do not have the ability to exercise a dual mandate like the US. The ECB is not able to buy government bonds unless they purchase them from resellers on secondary bond markets. Forced into purchasing these bonds at higher interest rates just adds to Greece's overall debt and makes for a more expansive effort to stimulate the economy.
So I'm going to be covering the policies adopted during the financial crisis of 2008 and the evolution of those policies made by the Greek Central Bank. So to begin, in August of 2007, the Greek Central Bank saw short-term money market rates such as the overnight suddenly start to surge. In response to this, the central bank announced with the provision of unlimited central bank liquidity with overnight maturity at the prevailing policy rate. This was the starting point of the financial crisis. This was fine-tuning operations in the money markets, and also during this time, the ECB, the European Central Bank, began front-loading credit extended with its main refinancing operations within the reserve maintenance period. This action was kept consistent until September of 2008, and during that time, we also saw an interest rate hike in July of 2008, which was mainly due to a heavy dominant German control at the ECB. But in 2008 of September, after Lehman went under, the ECB cut rates due to inflationary pressures by 325 basis points and stood at 1%. Beginning in October 2008, the ECB enhanced their credit support with switching to fixed rate tenders in order to improve liquidity in the marketplace. And later, all loans that financial institutions received from the ECB were fully collateralized and taken in the form of secured lending. And in May of 2009, the ECB finally added a covered bond purchase program to their efforts of stabilizing liquidity within the European economy. So at the end of the financial crisis, Greece received 2 bailouts and sold vast amounts of government bonds and established the ELA, or the Emergency Liquidity Assistance, which mainly helped with restructuring and creating stability in the Greek banking sector. So the evolution of Greece's monetary policy remains still in the position of following the ECB guidelines of the Mosaic Treaty, with keeping the guidelines of deficits of 3% and public debt to GDP of roughly 60%, which has not gone well since 2008. So after 2008, the financial crisis, in 2015, Greece defaulted on their debt and continues to run government deficits and poor structural problems due to the one currency dependency on the euro, following the guidelines of the ECB. So all the monetary policies that are essentially evolutionized over time, whether it be front-loading credit extended and having higher amounts of credit or so forth, are still seen under the ECB umbrella. And still, Greece today has poor structural problems in terms of their economy and monetary policy due to them being such a small country and not having as much say as relatively high German power in the ECB, which limits them to an array of problems, whether interest rates go up and they get contracted due to their relatively low GDP, but they have received massive bailouts and have defaulted, which is primarily due to the consistent pattern of following the ECB's regulations, as well as depending on one currency and having government deficits and poor structural problems within their economy and financial sector itself.